If you hear the words financial advisor and immediately picture some billionaire on a yacht, you are definitely falling for a myth that could be costing you heavily.
Oh, yeah, absolutely. It's a huge misconception.
Right. And the sources for today's deep dive make it super clear. Like, financial advisors aren't just wealth managers for the ultra rich, they are really crucial partners for everyday challenges.
Yeah, like if you're trying to optimize a budget, manage debt, or maybe set up a tax-advantaged college savings plan, even just building an emergency fund.
Exactly.
So the overarching mission of our sources today is to provide a roadmap for finding a trustworthy financial partner who actually fits your specific needs.
Okay, let's unpack this. The absolute foundational step here, before you even type financial advisor into a search engine, is defining your specific financial goals.
Right, you need to know what you're aiming for.
Yeah, because it's just like going to a doctor, right? A competent doctor runs blood work and checks your vitals before prescribing medication. A good advisor needs to audit your cash flow and understand your specific pain points. You can't just walk in, point to your wallet, and say, hey, fix me.
No, you really can't, because if you take a short-term goal, like saving for a house down payment to a retirement specialist, you could easily end up with a portfolio locked up in long-term vehicles.
Oh, wow, yeah, and then you'd face massive tax penalties if you try to withdraw that money early.
Exactly. Our sources break down several distinct lanes. So you have financial planners, investment advisors, wealth managers, and retirement specialists.
Right, so it's about matching the pain point to the specialty. Like, a wealth manager focuses heavily on asset allocation, while a planner might be better equipped to help you, restructure high-interest debt.
Right. And what's fascinating here is that the true professional designations in these lanes require rigorous education, testing, and ongoing ethics training.
Yeah, they really want to weed out people who just want to sell you products.
Definitely. A qualified professional will readily explain the specific mechanics of their credentials.
Well, that's great and all, but how do we know they aren't just going to quietly drain our accounts with hidden costs? Fancy credentials don't automatically mean my wallet is safe from bad advice.
That is a very fair point, and it brings us straight to the compensation conversation. The source material outlines three main fee structures you'll encounter. You've got hourly fees, flat planning fees, and asset-based fees.
Wait, asset-based fees, you mean they just take a percentage of the total money they're managing for me?
Yes, exactly. Usually around 1%.
How does that change their incentives versus just paying a flat fee?
It changes everything about their incentives, honestly. With an asset-based fee, their pay grows as your portfolio grows, which, sounds aligned.
Great, sounds like a win-win.
On paper, yeah. But it also means they might discourage you from, say, paying off a low-interest mortgage.
Oh, because taking money out of the market to pay down debt reduces the total assets they manage and therefore shrinks their fee.
You hit the nail on the head.
Wow. Okay, so a flat fee advisor doesn't have that conflict of interest, but then they might not proactively monitor your investments year-round like an asset-based manager would.
Right, there are trade-offs. And this raises an important question. If you ask a potential advisor how they get paid, and they try to dodge the question, or they just bury it in confusing jargon, what are they hiding?
Right. Refusing to clearly outline their fee mechanism is the first major warning sign. Transparency is just non-negotiable.
Totally.
Okay, so knowing their fee structure protects our wallet. But even if they pass that transparency test, how do we know they actually have our best interests at heart during a consultation? We have to evaluate how they communicate, right?
Absolutely. If we connect this to the bigger picture, an advisor's communication style is the leading indicator of their integrity.
Yeah, like if they throw a million acronyms at you or explain your options in confusing jargon, they're creating an intentional knowledge gap, right? Just to make you dependent on them.
Exactly. And that leads right into the ultimate red flags identified in the text. Guaranteeing investment returns, promising risk-free profits, and pressuring you into quick decisions.
Yeah, when an advisor guarantees a return, they are blatantly lying about the fundamental nature of the market. It's inherently unpredictable.
Right. If they promise zero risk, they are either hiding massive volatility or they're running a Ponzi scheme.
Wow. And the high-pressure tactics.
That usually means they are trying to lock you into a high-commission product like certain annuities or whole life insurance before you have time to actually read the fine print.
Financial planning should always be based on rational, informed decisions, because knowledge is only valuable when you can actually understand the mechanics of what you are buying.
Absolutely.
So what does this all mean for you? It means choosing an advisor is really about finding a transparent communicator who empowers you rather than confusing you.
Yes, it's not a popularity contest.
Mhm.
And for those looking to dive deeper into this, our sources highly recommend checking out EnableLoans.online to continue your financial education.
For sure. And I want to leave you with one final thought to mull over today. We just applied a very strict red flag test to professional financial advisors.
We sure did.
But if you applied those exact same rules, like rejecting guaranteed returns or walking away from high-pressure urgency to the casual financial advice you currently consume from social media or your
Oh,
friends,
that's a great point.
right, how much of it would actually pass the test? Would you still let that internet doctor try to fix you?